At Insightful Value, we don't chase hype. We uncover undervalued companies with real potential. And today, we're spotlighting a quiet performer out of Germany that's suddenly flying under the radar. CEWE Stiftung, Europe's leading photo service provider, has seen its stock dip, but does that mean trouble or opportunity? This video is for informational and educational purposes only, not financial advice. CEWE Stiftung and Munger KGaA might not be a household name globally, but in Europe, it's a dominant player in digital photo printing, photo books, calendars, wall art, and personalized gifts. With over 4,000 employees and operations across multiple European countries, CEWE runs a vertically integrated model that controls everything from photo upload to final product delivery. It's a niche business, but it's one where CEWE has built scale and loyalty. Financially, the company is conservative, solid, and profitable. Revenues for 2023 came in at around $700 million, with EBIT of roughly $80 million, maintaining a healthy double-digit operating margin in a competitive consumer market. Their return on equity has consistently hovered above 10%, and they hold minimal debt, a rare trait in today's leveraged environment. The company has a long-standing dividend tradition, with steady payouts and frequent increases over the last decade. The current yield is around 3%, with a payout ratio typically under 50%, giving it room to grow or remain stable even in tougher years. So why is the stock down? Recently, CEWE issued cautious guidance due to economic uncertainty, subdued consumer spending across Europe, and increased marketing costs. Some investors are spooked by slowing growth in print orders post-COVID when demand had temporarily surged, but others see it as a natural recalibration and a potential long-term entry point. CEWE is also doubling down on automation and digital workflows, aiming to enhance profitability and operational resilience. They've invested in AI-based photo sorting and faster production lines, positioning themselves for higher margins once the macro environment stabilizes. Another interesting angle, CEWE is one of the few ESG-friendly mid-caps in Europe with solid sustainability practices and governance. That could make it more attractive to institutional investors over time. Of course, there are risks. Consumer discretionary businesses always face cyclicality. Also, CEWE's success is tied to the European market, which brings exposure to regional downturns or currency fluctuations. And competition from online-only or app-based photo services continues to evolve. But from a value analysis perspective, CEWE is a unique case, a niche European brand with consistent profitability, strong dividends, low debt, and a temporarily low valuation. It's not a rocket ship, but it might be a steady climber. At Insightful Value, we focus on companies like this: undervalued, overlooked, and misunderstood. We deliver clear breakdowns of complex businesses without the noise, helping investors think long-term and act smart. Whether you're just starting out or already managing your portfolio, Insightful Value gives you the data that matters without the fluff. You can explore more detailed reports on CEWE and similar companies at insightfulvalue.com. And if this kind of grounded analysis speaks to you, make sure to hit subscribe and turn on notifications. Stay informed, stay curious, and visit insightfulvalue.com for more.